Aloha. I was just asked this question again. Is there a way to load pre-tax money into an infinite banking tax-free cash growth warehouse account and have it continue to grow tax-free? The simple answer is yes, but there are caveats and a couple of other things to consider. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. Now, if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. So, as I said at the outset, there are ways to put pre-tax money into a life insurance policy. One way is to have it housed within a qualified retirement account, such as a 401k or IRA. Now, I don't give legal or tax advice, and those kinds of strategies are not my wheelhouse. So, if you want to pursue creating a policy that you can load with pre-tax money, please consult your tax specialist or attorney. There are several other tax implications with infinite banking that I will address here, so keep watching. The caveat I mentioned earlier is that if you put pre-tax money into a life insurance policy, the death benefit will be taxed. Whereas otherwise, in most cases, the death benefit is paid out tax-free. The exception to that generality is if the estate is worth over $5.3 million. A portion of the death benefit may be taxed. Estates that are anything less than $5.3 million, the death benefit is paid out tax-free. The big question, though, is why would you want to put pre-tax money into any vehicle, really, where you will have to pay, or your beneficiary will have to pay, tax on the money upon payout or withdrawal? Back in the 1970s, when the federal tax rate was as high as 75%, yeah, it made good sense to defer paying tax. At those rates, one could reasonably expect that the tax rates would come down some. And when it was time to take withdrawals from the savings, the income tax would be lower than when you put the money in, and therefore you would be saving money by deferring the tax. That's not the case today. Currently, the income tax rates are at some of the lowest levels they've ever been. And when you look at the national debt, inflation, federal spending, and so on, what is reasonable to expect is that tax rates are going higher in the very near future. In fact, that has already been announced. So, deferring taxation now, when taxes are relatively low, to a future time, when tax rates are most certain to be higher, probably much higher, doesn't make a lot of sense. It might, however, make sense to create an account where the contributions can be a tax write-off. That can be done when a business buys a life insurance policy for a key person or employee of the business and pays the premium. However, in that case, the premiums paid, while providing a tax write-off for the business, would then contribute to the compensation of the key person or employee and would then incur tax to the employee. Now, there may be cases where that may still be an advantage to both the business and the employee. One such case might be if the owner of the business has the business buy the insurance policy on himself. Another case might be when the business buys a policy on a key employee and then would pay a bonus to the employee to offset the tax on the additional compensation. But again, those are situations requiring advice from a tax professional or lawyer. One of the really great things about whole life insurance is that the cash value grows tax-free, and you can access the cash value without triggering any taxable event by leveraging it with policy loans. So, while the money you put into the policy by way of premium deposits is after-tax money, it will grow within the account tax-free with compounding dividend interest. This tax-free compounding growth of cash values within whole life insurance policies is what the famous tax advisor Ed Slott calls the single biggest benefit in the tax code. That's a big statement. Now, if you don't know the name Ed Slott, he is a CPA and tax advisor specializing in retirement distribution planning. He was called America's foremost IRA expert by the Wall Street Journal. So it's safe to say he knows a thing or two about taxes and retirement accounts, and he's very well versed in tax law. So when Ed Slott declares something to be the biggest benefit in the tax code, well, you can take it to the bank. See what I did there? Tax benefit, take it to the bank. Well, anyway, okay. So here's why it's such a big deal. Qualified retirement accounts such as IRAs and 401ks defer tax, so you can deposit money into those accounts before you pay out any tax on it. And that way, there's more in the account than would be if tax were taken out before you deposited into the account, at least theoretically. But when you take distributions of income from those accounts, you will be taxed on that money as regular income and at the current tax rate at the time of the distribution or withdrawal. That is typically in retirement, as the accounts were originally designed for. The problem is now that the tax rate years from now, when those distributions will be made, will no doubt be a good deal higher than they are now. And that tax bite will be more hurtful in retirement when income is reduced from what it is now. The other thing is, those retirement accounts are not guaranteed to grow. You could, and many have, lose money in those accounts, especially if they're invested in the stock market. On the other hand, the cash value growing in whole life policies is guaranteed to grow and not lose money. And the growth is not only compounding, but tax-free. But the really big benefit, as relates to retirement especially, is that you can access your cash value without being taxed on it. And that means that you can use the money that has grown tax-free, and you can use it without having to pay tax on it. And while that is true with whole life policies in general, with the exception of most final expense policies, when a whole life policy is provided by a mutual company and designed properly, it will grow cash value faster and more robustly and at a lower premium cost than other whole life policies. Also, with businesses, that is, if you have a business, a side hustle, or even a hobby that you make some money with, and you have a business license, when you leverage your cash value in your infinite banking account for your business, any kind of expense for your business, you can deduct the interest charged to the policy loan from your income tax. Now, in that case, with the right insurance provider, you not only get a virtually free loan and continue to earn tax-free compounding interest on all your cash value, but you get a tax deduction for the interest charged on top of it. Yeah. So now I've covered the primary tax implications with internet banking, tax-free cash growth warehouse accounts, and it's all good news. So if you found this to be helpful, please, again, like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our 60-minute free webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, we welcome you to do that. The link to the application is below. We're here to help. We look forward to helping you. For now, aloha and mahalo for watching.